Welcome to the We Fucking Love Startups podcast. I'm your host, Troy Hammond, and on today's episode, we're going deep on Silicon Valley Bank, or SVB as it's affectionately known. SVB is the startup bank for Silicon Valley for a lot of investors, for a lot of startups across the States, Australia, and New Zealand. And so we really wanted to get something out quickly to show what's happened, why it's happened, and potentially what could happen in the future. I was lucky enough to get Danny Smith, the CFO at Storypark, ex-Icebreaker, Xero, Deloitte, to come in on a Sunday and help break it down for us. He's done a really good job of that. He's given out some really good thoughts on what's happened and why it's happened. It's absolutely not financial advice, as Danny says. It's just a really good conversation that I hope is going to help the industry and help people understand what's happened with SVB. So please share this around. Please comment. Please like. Please subscribe. Let's get this out because it's going to be, I think, really good for people to understand what's happened and what potentially could happen in the future. So let's get cracking on this one. This is a good one.
Kia ora. Thanks for tuning into the We Fucking Love Startups podcast, brought to you by Talent Army.
Yeah, man. So it's been a wild week, in the startup world. I'm not going to lie, So talk to me through, like we were talking before, what happened last night, especially.
Oh, so overnight, so obviously SVB, it's been in the headlines a big time, but overnight the SVB UK, a whole operating entity, which is a completely ring-fenced, air-gapped entity from SVB, from Silicon Valley itself, that got wound up. So same thing, there was a run on the bank, there was a little bit of nervousness that the funds wouldn't be available, and there was going to be a downgrade. So some VCs put the word out to their portfolios to say, get your money out, and that triggered it. And because they're all sort of networked, very well networked people, right? It's an ecosystem. And so everyone's saying, quick, get your money out. And that just makes a massive run. And they didn't have the funds to be able to support it. And so the UK equivalent of FDIC over there, or the UK Treasury, popped in and said, yeah, that's it. We'll have to close the bank down. So stopped issuing back on deposits and stopped investing further.
Based off fear. This is crazy, right?
Yeah.
And so let's just break this down a little bit if we can.
Yeah.
Some people listening to this podcast or watching will say, what the hell is a bank run? And so let's break that down simply first so we can get into some more tactical stuff later.
Yeah, cool. Well, when you think about it, what's a bank run? If you take a step back, what's a bank? What is a bank really for? And if you and I think about it, like from a retail point of view, we're going to put, a deposit in the bank. It's there for safekeeping. We might get a little bit of interest off it as well. If that was the extent of a bank's operating model, they'd be done in months, days even, if they only just took deposits and paid you interest, because they've got to do something with it. And so this whole concept of fractional banking is where a bank takes your deposits. So say you deposit $100 into a bank, they take that and they'll say, cool, we'll keep 10 of that 100 and we'll take that 90 and we need to invest that. And that's how they actually create and generate their own income and generate their returns. And that's what turns into loans or into mortgages or anything else that they're investing for themselves to create that value. But what it means is at any point in time, they've only got 10% or less of the outstanding, you plus everyone else that's put their $100 in. They've only got a portion of that on hand. So if you turn up and say, I want my 100 back, well, the bank's like, oh, cool, I can pay you back that 100 because I've got enough people that risk has been spread across and I can get 100 out of that cash that we've got on hand and give that back to you. But if everyone else were to do that at the same time, they don't actually have the money on hand right now to be able to give that back to you. So the whole nature of banking, it's like the sort of the institution of a bank is all about just betting that not everybody at the same time is going to want all their money back all at once. And so because of that, when you get a situation like it, which has happened, a bank run is where you decide you need your 100 out, but the person beside you wants their 100 out, and the whole way down the line, everyone says, well, I gave you that $100. You told me I could have it whenever I want. I want it back now. And if everybody does that all at the same time, extremely quickly, like in the course of a day, a whole bank can completely exhaust its reserves and there's not enough money left over basically. And so that's what a run on the bank is. And it's only prompted by panic and fear that I don't want to be the last one here to turn the lights out at the party, turn the lights back on for the party because you don't want to be the one who's left standing without your actual cash there.
So there's not just massive amounts of money in the vaults, banks sitting there that we thought, that we can go and take a couple of guns if we ever get desperate. And
that's it. Yeah. That's the thing. When you look, if you ever see, in the press or any of the like technical, industry publications, like $200 billion, that's the number of, that's the value of the assets that Silicon Valley Bank had at this point, $211 billion in assets. That's what they've basically only got about 20 or so, 10% of that. They've got about 20 of that that's available for everybody, and the other 190 or nearly 200 of that is what they've invested elsewhere. So it's still an asset because they've invested it, and it's theirs to pull back when those assets can mature. But they don't actually have it sitting in a big vault underground that they can just go and open up for you when you need it.
Is there a worse name for a bank that the government has to bail out than Silicon Valley Bank?
It's bad, eh? It's pretty bad. And it's really interesting too, because one of the things about Silicon Valley Bank, it's one of the more Silicon Valley stories you could hear. It was founded over a game of poker back in the late 80s on the premise that, we don't really need to be, why is the only banking facilities at the scale that we want it to be at, available to people who, need to have a, very big board and, everyone's in suits and ties and that sort of thing. Because in the 80s, as tech and startups were emanating from the region, the only place they could get facilities were these, the big four type banks, Chase, JP Morgan, that sort of thing, and Citi and Co. So the nature of Silicon Valley Bank was really sort of going counter to that and really looking after the needs of founders. And so they created products and they created structures and approaches and really served that market really, really well. And an important thing to remember as well is that the people at Silicon Valley Bank right now are going to be hurting themselves, right? That they're going to be feeling this too, right? No one wants to be in our business that fails. A bank is just a business. And there's a bunch of people in there as well. And they've really been looking after founders for quite some time. So yeah, it is a little bit, I think there'd be a little bit of opportunistic, maybe sort of stone throwing from the sidelines of people saying, you guys got too greedy. It was too Silicon Valley in your model to banking that you took as well. But they kind of needed to do that for a portion of time. The main thing really from my point of view, sort of looking at the data and the financials and everything over the last 4 years of what they've done, is Silicon Valley Bank wasn't really set up for the scale of the investing that happened through the pandemic.
Let's talk about that, right? Because we were talking about the numbers before off air, and the numbers are insane in terms of the growth that we've seen in VC funding. Like I think we've got a graph up on screen now that talks to SVDP deposits, so from VC funding, from at the end of 2019 was $61.8 billion.
Right, yeah.
By the end of 2021, that grew to $189 billion. So we had lots of VCs investing, a lot of that money going into Silicon Valley Bank. Silicon Valley Bank was like for all-encompassing, it was, if you went with Square, right, it was kind of out of the box, right? Like that you went straight to Silicon Valley Bank. So a lot of small to medium VCs, small to medium startups that got investment, their money goes straight there. Yeah. And so Silicon Valley Bank has to do something with that money, right?
Yeah,
and
totally.
So talk us through, like in your eyes, what actually happened and why?
Well, the interesting thing there as well is that even before the cash is deployed from a VC, there's a really good likelihood that it's also sitting in Silicon Valley Bank.
Well, lots of VCs had them.
Their own funds are sitting there too, if they've called it, right? Because there's a lot of uncalled capital, and we'll come back to that later in terms of what might happen next.
I actually heard, I saw on Twitter and I heard from a friend of mine that some VCs had big lending facilities from SVP, right? And
so those, when I was talking about some of the products that SVB did actually create, some of it was around some of that debt financing that they could do as well. So
that's the area of concern, right? If you've got debt financing through SVB right now, like
that's really tricky. That's a really tricky space to be in right now, because the only way that SVB would actually give you access to some of that debt financing, which typically is like, look, post a round, say you've closed 10 million on a round, and you want to make sure that you've got a cash buffer, because you dedicate all of that as much as possible to your actual operating burn. But if you want to create a cash buffer, like a facility in case, between months, or like if you've got really lumpy cash flow, say enterprise contracts, and you're paying your staff more frequently, you're paying all your vendors quite frequently, but you get big lumpy cash flow, sometimes you want to create a bit of a buffer. Well, a bank's always happy to lend. And so what they would do with the VCs is they would create these, it's like venture debt and venture security. So it would be like maybe up to so let's say 30% of the round that you just did would be loaned to you, but it would come with warrants and all kinds of ability to turn that into capital if things go bad and you don't pay back that as a kind of a payoff for the fact that there's some debt going somewhere that there's traditionally no one else is going to lend to. But in order to get hold of that buffer, Silicon Valley or any bank that does this will make sure that you only bank with them. So you're completely...
For those listening and watching this podcast, you've been kind enough to come in on a Sunday and your daughter is sitting around watching Magic School Bus and may interrupt us. And so if we don't edit this part perfectly back into where it was, we'll excuse that because she was as cute as all things, as well. And so, we were talking about VCs had their own money in there as well.
So I mean, you got that graphic up on screen where we see the amount of money that's going into the sector in general and startups in that ecosystem.
And is that, sorry, can we just, before to preempt that, is that largely because surfing, all the big, huge tech companies, right, low interest, growing like crazy, they were looking at doubling and really being aggressive about their growth. Off the back of that, other startups had to compete, so they had to raise more money to be able to hire these people, and so there was a lot more investment for those purposes, and then that money then obviously goes into places like SVP.
Through the pandemic, so from 2019 onwards, when all of the central banks had to just stimulate the economy as much as possible, there was so much money in the economy, and there still is, and that money always finds a home, right? And it tends to gravitate towards wherever it can make good returns. And so all of that money sitting with either high net worth individuals or family offices or institutions, they want to park that where they can get the best sort of returns. And so at the same time, a lot of money's been funneling to VCs, who are the vehicles to get that funding back in, to get the funding to the place where they can get good returns. And so because all that money is available in there, it does pump a lot of energy into the system. And so with a lot of that consolidation of talent that was happening, certainly in Silicon Valley in general, but across the board around the US and globally as well, it just creates a lot of intensity in funding requirements and cash requirements. So it sort of becomes a bit of a self-fulfilling prophecy in a way. There's more money, therefore it goes into investing in more tech and more startups, and then those more startups then need more money to sustain themselves as well. And so the graph that you've got up on screen there, one of the things you see at the very tail end of it, it spikes. You can see that jump from 19 to 22. It would be maybe 21, but at the end of that it starts to come off, which we know was the case through all of the down rounds that were happening, or the lack of funding that was going in there, because as interest rates go up, well, actually there are other places that money can go, and there are other things that people can, who would ordinarily, the LPs that would be investing through VCs, they can find other ways to deploy their own cash. And so as that cash comes off, what we've created over the previous 3 years is a whole bunch of startups that are burning cash. And they need that cash constantly coming in to sustain themselves until they get to a point that they've got their market fit, they've got their their distribution, they've got everything they need to do to be self-sustaining and can start to be closer to break even and not burning as much. So that cash off that's coming in through VC created a bit of a vacuum, and that creates a little bit of a tightening. And so all of that money had been through that period, had been going to places like SVB. And they're not the only one. There are some other lenders, some other banks out there that have been taking a good balance of it. First Republic's another good example, but they're in a very different position to SVB, which we can talk about a little bit more later too. But with all that money coming off, SVB now is looking at all of these clients that they have that had deposited all of these rounds with them, burning that cash without more coming in. So the tap's kind of just tweaked off a little bit. And so when that happens, it starts to shorten up the amount of deposits that they actually have on hand. And the other really critical, probably misstep that they took through this period of time was banking on the fact that interest rates would never rise. And so, hindsight, I don't want to be Captain Hindsight here today and then say, we should have done it differently. At the time, interest rates were never looking like they were going to go up. Inflation was this long forgotten thing from the 80s or 90s that no one ever really needed to pay attention to.
But even if it did, right, so to an uneducated finance guy like myself, right, so if you're going to be making investments in perceived safe bets, right, like security, government, what was the, did it happen too fast for them?
Yeah, well, one of the things, so the decision making that they did, which we can only really speculate on why they did that, was they bought quite a lot of long-term debt, so bonds, and treasuries as well. And what that did is it means that you lock in effectively an interest rate that this is going to keep paying you back over time, and then that's baked into the price of the thing that you've bought. So that's, when I say bought it, that's what they do with the deposits. They go and invest it in these things. And so mortgage-backed securities is one of them. And there's a big glut of those mortgage-backed securities with SVB. You can see it in their financial statements. There's a big chunk of them. But they're really long-term, which is the problem, because those really, really long-term ones, they get locked in at a certain value, and at a point in time in the future, it will pay you back, and you get a little bit of interest off it along the way. But now that the interest rate started to go up, so when the Fed sort of late last year, late 2022, started to increase the rates, well, what that does is it totally changes the fabric of all of those instruments that they've bought. And if you just went back to the Treasury and decided, so if maybe mid-2001, if you bought a US Treasury bond, like 0.5% interest, which is a good proxy for how valuable it is, right? If you've invested in it, it's going to give you 0.5% interest over time, and that gives you an idea of how valuable that is. Well, when you start increasing interest rates, the US Treasury, you go back there now, if you went back there right now and asked for a Treasury bond, I don't know what it is exactly right now, but it's in the realm of 4 to 5%. So immediately it's like 10 times more valuable to have bought a bond now that looks like this and is going to pay you back over that rate, over that length of time. So when you compare that, what's available on the market right now, to something that you've bought a little while ago, that is going to be much, much lower value. It's still a Treasury bond, but one's just worth a lot less. It means that you have these assets on your balance sheet that you need to start to look at, actually that thing's soured a little bit. That's not as valuable as something that I could get in the open market right now. And so one of the things that you need to do for like reporting and accounting purposes is you need to just constantly be disclosing what's the actual value of the things that I've bought in the past and I'm holding as an asset. And that was the real thing that caused all of this to really kick off, was these really long dated, like 10 years plus kind of bonds and securities that were sitting there that started to get really sour. And then Moody's, which is the ratings agency, had a conversation with SVB at the start of the week saying you need to do something about your balance sheet because we're going to downgrade you if you don't actually take that into
consideration. Because what were they then? They were
AA, yeah. And there was talk about them dropping a couple of tiers, which is significant. And if you do drop a couple of tiers, then and to some extent you kind of need to feel for SVB, like the leadership a bit at this point, because you're kind of damned if you do, damned if you don't.
Yeah, stuck in a rock and hard place, right?
Exactly. Yeah. If you don't do anything about your liquidity, you don't do anything about your own balance sheet, then Moody's is going to downgrade you. Boom! Imagine that headline through the market, right? And then suddenly everyone's like, "Oh my gosh, what's happening now? Quick, and stock price comes off. Everyone, VCs go, oh, they're about to crash. Get your money out." So you're in the same position regardless. So they're in a bit of a rock and a hard place, and it's basically the conditions for all of this were set over the last 2 to 3 years, just because so much money in the industry, so much of it ending up in one place, and that one place wasn't structurally equipped to be able to place enough bets across a number of different portfolios of assets that they would invest in, so that they weren't really isolated, just looking at these really long-dated mortgage-backed securities.
So a couple of questions for you there. So when you say so much investment, I mean, we're talking like almost half of venture-backed startups, were deposited in SVP.
They are it. Like that's the thing about SVP, like how prolific it is. Technically, it's only, I think, 18th on the list of in terms of market cap size for them, or the net assets that they have under management. Net assets that they've got, 18th on the list. So at the top of the list, your JP Morgan, Chase and Citi and that sort of thing. So they're 18th on the list, but it's still massive. And also in terms of how active that they are as well, for not just startups, but I think I saw a stat over yesterday that it's about 40% of IPOs over the last couple of years, and tech IPOs over the last all banked SVB. And when you IPO, it's not a case of cool, we got through the IPO, so we'll see you later, we'll go and bank with JP Morgan now, thanks. Like you still maintain those relationships. So there's a bunch of listed techs that are now looking at their banking facilities going, can I get hold of that cash or not? So I wouldn't be surprised, and I'm not going to name any names or trying to stoke any fear or anything, but I wouldn't be surprised if there are some tech companies over the coming couple of weeks that are listed that need to make some disclosures about their own liquidity because they can't necessarily get access to the funds that they might still have with SVB.
Yeah, I know it's big companies, right? Like very, very big companies.
Yep.
We're talking unicorns.
Very much.
The reason why I wanted to get you in today, because unicorns have probably a lot more of an unfair advantage in times like these where they can actually get access to cash a lot easier and faster and, well, not necessarily the amount of cash that they need, but what I'm more concerned about is the smaller and medium businesses that, have a payroll coming up now and have, potentially 250,000 US, but let's be honest, like 90% of the deposits at SVB were uninsured depositors. And so, like realistically, no money coming in. And so talk me through if I'm a founder in a startup in New Zealand or Australia or the US right now, what should I be doing?
Yeah, it's a tough spot to be in. So, to that stat around like the 250K, that's the limit that is insured by the FDIC, who's the agency that was set up by Congress in the US to take over when a bank gets wobbly, and that they've been insured to every depositor. So a given company that's banking with them, maximum insured, as in guaranteed, tomorrow you could draw that if you want it, is 250 grand. And so that stat of the percentage that are uninsured in there, every single entity or every single company that banks with SVB or was banking with SVB up until Thursday is insured.
Okay, good. Yeah.
It's just basically none of them have only 250 grand sitting there. So when you look at the total pool of funds, because so many of them have so much more than the 250, that so much more is the bit that's uninsured.
Okay.
So they all do have access to that 250, but it's the balance that's the problem.
Yeah.
Because some of the scale of organisations and medium-sized entities that are making payroll, you get through 250K pretty quickly.
Yeah.
It's a pretty quick cash burn to get through that. So it doesn't really help. And that whole scheme was actually really designed more for retail banking. Mm-hmm. The whole scheme was set up so that individual humans could at least have a limit that they would be guaranteed and insured for, but it wasn't really designed for banking situations in business like this. But in terms of what to do right now, there's not a heck of a lot that can be done if you haven't got diversified banking already.
Yeah. So diversified banking, right? So interesting you're taking this. A lot of Silicon Valley guys I've chatted to over the years have always talked to me about diversified banking, and I'm like, yeah, but like startups in New Zealand, right? When you're going to pay bank fees and the likes, and you're like, how the fuck? Why should I have diversified banking? I get it now, right, in hindsight. In hindsight now, but let's be honest, majority don't, and so they might have all their funds tied up that they can't get access to right now. Yeah. They're scrambling to say how can we make payroll. And so, I've seen some great tweets out there and some great LinkedIn posts in terms of what people should be doing. You should be looking at emergency capital straight away. You should be stopping payments on everything across the board and making sure that CFOs and CEOs collectively both sign off on every single payment that goes out right now. Talking to your employees and being really honest and saying this, unfortunately we're affected, with SVB, but man, it's tough. Right?
Yeah, it is really tough. And some of the thing, one of the things I mentioned before as well, that not all of these, so all the VCs, they've got a lot of skin in this game right now, and not all of them will have necessarily called all of their own capital for the funds that they've got. So if they've got undeployed funds that they were previously sort of keeping aside for, subsequent rounds or any kind of follow-on investment that they were going to do, potentially that hasn't been locked up in this SVB crisis, and so there's a path potentially that VCs can get access to more funding for those rounds, but they wouldn't necessarily just pile into another round. It might be a form of debt that they issue to say, look, this is kind of like a bridging loan, right? Between house sales, just to make sure that you can actually make your payroll, because a lot of these firms are still trading, they're still they're not burning absolutely everything, so there is still revenue coming in, so you can pay down some of that debt if you do need to, but it's kind of wherever you can find the funding and however you can shorten up the amount of cash going out, the better really. So really flex your vendors that are sending you invoices and they demand payment on the 30th, get on the phone to them, just check that they're good. But the problem is as well, in general, everybody's on AWS or Azure or GCP. You can't really. There's a bit of concentration of vendors as well in the ecosystem around. So we don't really want to sort of translate all of the pain immediately onto all those vendors, and then all those vendors fall over, because then now we just don't have business, right?
Yeah.
So it's a real shock that's coming through the whole system. But yeah, like real fundamentals of cash flow management, really sweat what you can pay out as late as possible, and also from your like inbound and receivables. If you're B2C, like hustle on making sure that everyone is paying it in full and on time. If you're B2B, making sure that your account management is working on point, and anybody who's starting to slip into 30 days or 60 days overdue, you're like getting on the phone. And I think right now there's a lot of CFOs that are probably sweating and really sort of sweating their own aged payables and receivables.
Is it prudent, right, to be looking at where the hell your funds are going right now? Like if they're going to the right bank, like should they be setting up other bank accounts in the States quickly if they've got American revenue coming in?
Yeah, totally.
So what do they do? What do they do if they've gone through the Square out of the box solution? They've got SVB. They've got a lot of revenue coming in through via the States that is going to SVB. How should they move that quickly to another bank?
So I don't have a strong view on whether like neobanks and some of the like non-traditional banks is that a good idea right now, rather than chasing more stable capital. But I have seen it suggested as an alternative, and I've seen from a lot of the neobanks that are sort of Y Combinator sort of startups that are just absolutely awash right now, and people trying to throw them money to say, look, I need to move from wherever my funds are. I need to get a facility with you, just because they've managed to get their money out of SVB. But like, what do you do with it now? So if they were the lucky ones to get it out, where do they go and put it? But yeah, setting up whatever other facilities you can find and get hold of as well. And one of the advantages of SVB was it was below a certain threshold of scale of banks, so it wasn't as complex and as hard to get like through the anti-money laundering and counter funding of CFT, the counter funding of terrorism regulations. Like there's bog standard of that, and SVB was able to sort of speed up some of that and make it a little easier to be a startup and not have to have too high a compliance cost. The fact that there's a whole bunch of other banks out there that do want to take your funds to invest, it might be a little bit higher friction. So it's going to be pretty sweaty kind of days to weeks now getting through that and making sure that you do have facilities that you can use and call on, so that if you do get some debt financing from your friendly VC that's happy to help, because they don't want to see you go under, because then they lose their whole bet. Having another place to be able to park that is going to be pretty important.
Yeah. So I imagine a lot of VCs are really busy right now looking after their portfolio of companies. Does that mean that if people who have started the process or halfway through the process of raising capital are in trouble?
I wouldn't be able to say whether they're in trouble or not, but those VCs, like you say, are going to be very busy right now, making sure that their portfolio, like however they can help their existing fund portfolio companies, that's going to be really important to them. Obviously, I don't want to lose what I've already done. Versus I need to
protect my investment.
That's it, right? Yeah. So everyone's needing to act quite rationally at the moment, and so I wouldn't be surprised if it takes a little longer for VCs to come back to either committing to IMs and term sheets and actually progressing things along as well. I've heard of rounds at the moment that were like literally funds were being transferred and processed and they just froze up. And so it didn't actually make it out before the kind of wall went up. So I wouldn't be surprised if there was a bit of a stall at the moment in terms of just the activity and deal flow that's going on within the community.
So we're hearing this word a lot online at the moment, contagion. What is your thoughts on whether this is an isolated event to SVB or a potential contagion across banks?
I mentioned First Republic earlier. They've got a similar sort of clientele, more skewed towards like higher net worth individuals that are, and quite a concentration in Silicon Valley as well. And they've got a lot of venture-backed firms, entities that had been invested in banking with them as well. But and there has been some speculation, and they took a stock price hit. I think they dropped like 30 or 40% on Thursday or Friday as well, because cripes, that's another example of SVB quick. If you're an investor in those banks, people were selling, and in my opinion, that was premature, and actually it was just based in fear. And the thing about contagion in these kinds of situations, and is there a ripple effect? Is this another GFC? I genuinely don't think it is, because I saw a great press release from one of the VPs at at First Republic, and they said the nature of what's happened at SVB is really idiosyncratic, like it's really specific to them and their situation. And what they really mean by that is most of the other banks around, except like the neobanks that are starting up very freshly now, most of them have their own loan book. Because you go back to that example I gave, $100 into a bank, and what do they do with it? They go and issue a loan. They do mortgages, they do business loans, they do commercial, they do all sorts of different loans themselves, and they've got their own retail operations and commercial operations. Silicon Valley doesn't have that, and so the only thing, well, they do have some, but it's really small and really minor in terms of their scale. So the only thing they really can do is buy other big aggregated products, which is what those mortgage-backed securities were. Now, First Republic, they have a pretty prolific loan book, and they've got it's down to they're issuing mortgages for retail, a single house on a street kind of a thing, right through to commercial development and business properties as well. So their diversification, which is the catchword at the moment, and it's going to feel like it sort of loses its impact when you say it, but the diversification that a lot of other banks have, both on their depositors and what they do with that deposit money. Most of the other banks, if not all of the other banks in the system, are actually going to be okay.
Because they have the oxygen to be able to keep going, right?
They have the oxygen, but also they've got really defensible kind of reasoning why there's nothing to be concerned about here. Because they might have some mortgage-backed securities that are out 10 years plus that have come down in value, but it's not going to be as high a concentration as Silicon Valley did. So they can say, well, yeah, that's probably soured a little bit, but it's only a small part of our balance sheet. The rest of it's actually still really, really good. So the contagion effect is, well, what happened, and if you think of the global financial crisis, right, through 2006 to 2008, what happened was that all of the banks had all concentrated all their efforts into these subprime mortgages.
Yeah.
And they had all of these assets that they had invested in that all of them soured all really quickly, and then they all fell over really, really quickly because they had all invested in the same thing. And they had huge value of their balance sheet locked up in this same thing. So if that thing goes, then it's a house of cards. And that's what happened in that global financial crisis. Now, after that, when everyone picked themselves up off the floor, the regulations that came in created a whole bunch more mandate around how diversified you needed to be, how much capital you needed to hold on hand versus how much you had actually loaned out. And so the structural stuff inside of the banking sector at the moment is way stronger than it used to be.
So where were the regulators for SVB then? Where were the regulators saying, hey, this doesn't look good, if the interest rates go up, which they're going to. Yeah, so Forbes curse at it again, right? So Forbes released a paper on the most reputable banks, in the States, which SVB was, was in and tweeting about 4 days ago. And so where were the regulators, looking at SVB and giving us some warning like that? There has been, some big talk, up until those. So I know Raging Capital Ventures on Twitter in, 19th January did a big tweet storm on their concerns on SVB and, how people should be looking at them and what's happening there and their worries. And so where was everyone else? Where was the Fed?
One of the things that happened over the last I think it's maybe 6 years or so now, leading into the pandemic and the administration in the US that was in play at the time, wound back a few of the regulations, essentially lifting the floor of your net assets value, that you needed to comply with another set of really intense regulations and what you need to do with things like the value of those long-dated securities. When that all happened, Silicon Valley was, the scale that they were at was let's call it around 60 billion. And then over the intervening time between there and now, their actual, the amount of funds that they're needing to deal with skyrocketed, their market cap skyrocketed, and they've got net assets now up at 211, or they did up to that point. The cutoff to be into the new kind of regulatory space is 250.
Oh, wow, very close.
So they got really close to needing to comply with a whole bunch of new compliance and new regulations as well, but they weren't there yet. And generally with regulations, and certainly in finance industry, you don't voluntarily jump into these things because it does create a lot more cost for you. And it is less profitable per account to be able to do this. But some of the disclosures that the bigger cousins that they've got that are further up the market cap tables in terms of banking, they're doing things that essentially discourage them from making the bets that Silicon Valley were making because they knew that wouldn't fly when it comes to reporting time, and they had regulatory pressure to not make those sorts of bets. So the regulators there, the floor of once you pass through that, this is now your new regulatory scheme and regulatory regime that you're part of. It's there for the much bigger banks, so the real biggies, and Silicon Valley just wasn't quite there yet. Probably unchecked, it probably would have gotten there within another year, and then that probably would have been a cause for a bit of unwinding. But back to what I was saying before, the whole regulatory scene and the way that industry hangs together, there's a reliance on the regulator, obviously the banks and their self-regulation that they do as well, but they also rely on a little bit on the ratings agencies, like Standard & Poor's and Moody's as well. And what we know, one of the things that's really tipped all this activity off was at the start of the week, about the time as most reputable banks and stable banks are happening, Moody's is actually having a conversation with SVB saying, your balance sheet's not looking great. Like, we've seen your 10K filing from December, your balance sheet's not actually amazing, you need to do something about that. And so that set off a chain of events that middle of the week, SVB decided to sell down a bunch of, basically liquidate a bunch of the assets that they had invested in, but because those were underwater a little bit, they sold them at a bit of a loss. So they lost $2 billion on getting rid of some bonds. And then at the same time, to patch that up, they went to issue some equity. And those two events were very public, like that's the nature of them. The market learned of them straight away and had a very violent reaction to it. And that's how they lost 60% of their stock price overnight. So the agency did what it was meant to do. The way that Silicon Valley handled it was probably a little bit bung. They potentially should have done it in the other order, done the equity invest, because the amount of equity that they tried to raise, the capital injection that they wanted was about $2 billion. They did 3.5 or 3.6, I think, last year alone anyway. So it wasn't out of the ordinary. It wasn't kind of like an end of days, quick bail us out kind of a ask for shareholders to pile into this. So if they'd just done that first, and then done the sell-off of their the things that were a little bit illiquid, then they probably would have been okay.
Do you think they did that because they had the trust that the community wouldn't turn on them so fast?
Yeah, one of the things about banks and banking in general is that it's really easy to confuse sort of price loyalty and my package loyalty and relationship loyalty with existential loyalty, right? So if you just suddenly believe you had a great relationship with your bank, they've given you competitive mortgage rates every time you've gone back, and they've go, oh yeah, cool, you've been with us a long time, we'll hang in there with you as well. It builds a lot of loyalty. But if I told you that the bank was suddenly going to foreclose on everything and you were going to lose everything, pretty quickly that loyalty dries up. And the thing that banks overstate, I think, is how loyal their base will be. And Silicon Valley probably had a little bit of that as well, that we look after all the VCs, we look after all the tech and all the startups in the scene. Look at the size of it. We're essentially in this bit of a bubble in terms of their worldview, that they felt maybe a little bit too big to fail, so no one would run away from us as well.
So we largely should trust banks then? So a lot of people telling me, hey, look, there's a lot of crypto bros right now with red eyes staring at us going, I told you, throw all your money into crypto.
Had some thoughts on that overnight from some friends asking me to talk about that here as well. Banks and banking will do what banks and banking does. We don't always have to just follow the flock ourselves, and the rational decisions we can make as independent actors, and businesses and startups are no different to this as well. And I think having some diversity in where you put your bets, because think about it this way, when you put your money in a bank, whether it's after a round or whatever, you're effectively loaning that to that bank. And they've
loaning it to the bank and then loaning it out to someone else.
And then they're loaning it out to someone else. And so you're loaning it to them, and they will say that, and it's pretty well understood that they'll pay you back. They'll give you that back when you need it and when you want it. Would you make a loan or make an investment to only one particular place that could live or could fail or could struggle as well? Or would it make more sense to have a little bit more diversity in where you've put that? And so banks, fundamentally, the banking and the banking system is trustworthy as long as we play in that system the right way. And
so
as long as we spread our risk around a little bit.
So when you're saying we should spread our risk, if I've got $10 million, what's your basic example of what I should do with that money then?
This is not financial advice. Be very, very clear. I'm not giving any financial advice, and nothing that we say today should be taken as financial advice. Splitting that up into 2 or 3 different facilities and 2 or 3 different banks is actually a pretty stable thing to do. The only way you would lose all of that is in a GFC kind of scale of banks going under, and that has a massive ripple effect through all of them as well. The nature of SVB, you compare SVB and First Republic side by side. If you had just gone 50-50 with each of those there, you've still got the ability potentially to pay your payroll when you need to, while we figure out what happens with the other. Because the thing about Silicon Valley right now and all the funds and the deposits that they had, it's not disappeared. It's not gone. FDIC came in, shut the bank down, opened another one right beside it, have all the employees of the previous of SVB are all over working for the new bank at a 1.5 times salary. They've just said, look, come in, we need the people in this bank to be able to still run this. The deposits concept is still there. It's all backed by really long dated securities. So what FDIC has to do now is just slowly liquidate that stuff to create a better liquidity position for that bank, that new bank that they've created, and then they'll be able to start replenishing and serving back to everybody that wants to still take their money out. So it's not like it's all disappeared, it's just slowed right down because everybody wanted it all at the same time. There's just a rush for the exits and you can't all fit through at the same time. So FDIC comes in to do a really slow and orderly kind of selling down of all of this stuff until they get to a point that actually the liquidity's right, the hype's gone, and it could very much be a sustaining organisation at the end of that. It absolutely could be, but the brand of Silicon Valley and what it's become has probably been pretty well hammered by this. So if you'd split your bets a little bit, then that's probably going to take a while, weeks to months kind of thing to unwind. Washington Mutual was the most recent large-scale one in 2008 that this happened to. That'll unwind and you'll eventually get your funds back. But if you've got funds somewhere else that you can also make payroll in, then that's where you can go to be able to pick that up.
And so do you think this makes a new path for Bitcoin and neobanks, and is this now a concern that people have with traditional banking? So I know one of your friends asked the question around like fractional reserve banking and fiat and the likes. Do you think people are starting to look at this now and say,
I think my personal opinion on this is that crypto is still going to be super volatile in the near term, and so if there was a rush to just pump everything into crypto, say you had done around 50 million Series B or whatever, and then pump that all into Bitcoin, and then suddenly Bitcoin skyrocketed 4x what it is, or dropped to 1/4 of what it is, how stable is that versus is that the most stable system for you to be interacting with when you've just secured that and you're valuing your company against that? If the underlying value measurement system is unstable, then your own valuation and your ability to recruit and attract talent, like all of that's going to be really quite unstable. The bit in the middle around neobanks might actually thrive out of this. And that's the one that I think probably is going to be something that takes off because all this money will find a home, and the neobanks are the sort of the halfway house between the two. They don't have all the institutional craft that a lot of the traditional banks do have, and they can be a little bit more nimble and come up with interesting products and services that they can sell to individual businesses as well. But inherently, if they're not listed or they're not a at scale organisation, again, you have the risk problem. So I wouldn't if I managed to get all my funds out of Silicon Valley, I wouldn't then go and find the closest neobank and pump it all straight back into that as well. Like if I was going to do it, I would probably spread my bets a little bit as well, because at any point in time, they might fail. They've all got the same legislative and regulatory needs and oversight as well, but they're all a lot smaller, so they don't have the same sort of requirements that that Silicon Valley would have gotten to at the scale that they were about to hit into. So it's just a case of making sure that you just think about how broad you can spread your bets. And I don't know, like a rule of thumb, if you can make payroll for a couple of months from at least 2 facilities, that's actually a reasonably good rule of thumb. And that you can do all sorts of things around term deposits or CD, certificate of deposit, it's called in the US. You can have these things maturing at a stage, and just by splitting where those are all sitting, you can be a lot more diversified in your risk profile about where your investments have been sitting.
Awesome. So what's next, right? So what do you think is going to happen? Are they going to get acquired over the weekend? It's Sunday here in New Zealand, Saturday in the States. Well, Sunday morning there probably. No, Saturday. Do you think they're going to get acquired? Is Goldman or someone going to come in? I know Elon's saying that he's going to buy Twitter Bank, which I was laughing at. There's a whole talk, a whole lot of out there that, someone's going to come in and savage them and buy them for next to nothing and pay back all these deposits.
Yeah, well, I mean, when you think about the amount of business and the brand and everything that comes with, having scooped that up, it would definitely be plausible for a bank to come in and do it. I think so through Wednesday and Thursday, behind the scenes, it sounds like SVB were trying to find a buyer to bail them out, basically. But the problem is that the stock price was just plummeting. No one could agree to terms. Like, what sort of term sheet are you going to sign in terms of like what's the current EV of this place? What's the current market cap really if it's dropping 10% an hour kind of thing? How do you choose a price for that? So there was interest for sure on actually doing an acquisition, but just the price would be so hard to actually agree. So I wouldn't be surprised at all if part of what FDIC are doing at the moment as well is looking to find and help negotiate to get something that will actually stabilise all of this. So it could be very possible that inside the next week to 2 weeks, there's a lot more clarity, a lot more certainty given by an acquisition potentially, and then that gives everybody basically the clamps come off the accounts and everybody can get back access to what it is, and it will be under a different mark, a different brand, backed by any of the bigger brand banks that are north on the market cap table from 18 or 16, where Silicon Valley is. It's completely possible for sure.
Yeah. So I know like the Y Combinator folks and a few others are saying this could potentially be an extinction event for a lot of startups. In your opinion, you don't see that happening? This is crystal ball shit here, right? Yeah, right. I know.
I was thinking about this.
Shit question.
I was thinking about this morning when I was coming in. Like, do I want to be that guy like Neville Chamberlain on the he's landed coming back from the Munich Accord, right? We'll have piece of our time. Definitely don't want to be that guy that in 3 months' time everyone's laughing at me.
Who was the guy? Who was the finance guy that does? No, it was like 5 days ago. He was saying buy shares in SVB. He was like, this is the best time to buy, and I was like,
Kramer. From all it. Yeah. I mean, anything's possible, right?
Yeah.
That example I gave of a larger bank coming in and scooping this up, or some kind of federation of banks, chopping it up and actually selling it off in parts. Completely plausible that happens. Equally plausible that it doesn't. And what that could mean is that FDIC is then sitting on trying to operate this bank and sell down as much of the actual asset base that they've invested in, all of these long-term, mortgage-backed securities or treasuries, like sort of piecemeal selling those assets off, and releasing off 10 billion or 5 billion at a time, and then being able to sort of choose the account holders that now suddenly can draw down a little bit more. So they're kind of in this full receivership mode of the bank to go, well, what can we liquidate? How do we use that to then pay to the people who have deposited with the bank? That could take a long time, and if that takes a very, very long time.
What's a long time?
It could take weeks to months for that to actually be a reality, that they're actually be able to process all of this out, because suddenly there's the other thing that the financial system as a whole doesn't really want is a whole bunch of selling all at one time, right? Because then that suddenly crushes all the inherent value of everything else that's on the market, right? So if suddenly you've got a new supply of, if you use the housing market, suddenly if 10,000 new houses overnight suddenly erected, this is a ability to sell these things now, all of the housing values will just drop because supply and demand means the price will drop. So FDIC have to be careful of that too, because they don't want to then suddenly tip over a whole bunch of other banks that were fine, and then the actions that they take mean that they might tip them over. So FDIC is going to have to be really clinical about how they do it, and that generally means pace is not a priority.
Yeah.
So it could mean that some of these funds are locked up in there for quite a bit of time, which is super unfortunate. And I know that's going to be really challenging for a lot of organisations. And we know of some we've heard of some tech companies New Zealand based that their operations are over there. As you were heading over there and chatting to the advisors and VCs, where do we bank? Silicon Valley.
Yep.
So you take the advice of the people with the money and who's parking money with you. So that's where it's all gone. So I really feel for a lot of the tech founders and investors as well, like the VCs that have supported these firms. They're going to do it tough over the next weeks to months potentially, unless someone does come in to bail out and essentially buy all those assets all at once.
What does this do for the economy? What does this do for business confidence? Interesting, right? So if you had said to me a couple of weeks ago, how's the market, Troy? As a recruiter, we're a bit of the canary in the coal mine, right? I would have said, it's feeling a little bit more optimistic all of a sudden. It's been pretty terrible for the last 6 months, 12, we've seen it coming for probably 9 months. Starting to, confidence is picking up a little bit, and then we have, unfortunately, a whole bunch of layoffs here in New Zealand. We have big tech companies. One of your former mob, Xero. Shout out to all the Xeros that just lost their jobs.
Feeling from a team, from a crew. Yeah.
As someone that has been stealing Xeros for the last 7 years, I can confirm that they are good hires, and so totally recommend.
Well, once in a career opportunity to snap up a whole bunch of amazing talent right now, for sure.
Yeah, I believe there's a hashtag out there, hire a Xero.
Xero, for sure.
Yeah, so check that out.
Yep.
Sharesies, Atlassian, and so all in the last week, a couple of weeks, and I've been like, well, business confidence was feeling a bit, I was feeling a little bit more confident. Now not so much. It's still largely like in my world, feeling okay. Like the companies that had money in the bank last year, still growing, other startups, other companies pushing forward. Do you think this is going to shake the market up a little bit?
The market that I think would shake up out of all of this, like Net, talking about all those, there's the brands that we're talking about, and certainly of this last week, probably the market that's probably going to have the most shake up is around the employee side. Because we were just talking about supply and demand before, right?
Yeah.
We're about to see a whole bunch, and we're already seeing it, a whole bunch of supply come into the market. That was the thing that was really scarce before, that was causing a whole bunch of salary pressure upward. I'm talking sort of CFO point of view here, like noticing that and seeing that through recruitment rounds and saying, oh, right, okay, that's where the market is. Oh, it's there now. Oh, it's there now. That's when supply is relatively constrained. And a lot of that talent was being sort of hoovered up by a lot of companies that got quite big. And we're just seeing probably a market correction in that over the last sort of 3 months or so. We're seeing that correction play out. And so when that correction happens, then, well, if you've got a lot of talent in the market that are looking for new roles, potentially that means that they're not going to be able to command as much of a premium because there's not as much prolific bidding across the board for all the different roles. So there might be a little bit of heat taken out of the, and I'm not sure what your experience has been.
17% lower since this year, calendar year alone. So
there you go. Well, that was my guess, and that's your data,
well, that's
right?
our data, yeah. So definitely lots of folks at the moment coming onto the market, concerned about finding a job. I've been trying to post a lot more on LinkedIn and other things lately. Redundancies can be good things, so my story, I've been made redundant, unfortunately, a bunch of times. It's just unfortunately part of business, especially if you go in riskier sort of industries. Sure. I was made redundant at Vend when they had to let go of 65 people. I had 2 little babies, 2 kids. I took a big hit to go to Vend. I went from, being paid quite a big salary and lots of commissions in recruitment to going internally into a startup. You don't get paid the most.
That's tough.
But then I was like, well, what the hell do I do now? Maybe I'll just set up a company, and Talent Army was born. And so a lot of positives can come from these, redundancies and the likes. So I really encourage people to stay positive, to do the right things, to think about what they really want to do with the next chapter of their life, be aggressive about it, go for it, work on their CV, LinkedIn, personal brand, have a good CV that you can tailor to every single job, that you don't just, plaster the one CV out. But use your networks. Get out and talk to people.
For sure. Yeah. And at like the human level, the individual person level, the knowing what I know of some of these adjustments that are happening at the moment, there could be, sort of 6 roles in a broad team that now are down to 4 roles. All 6 people, absolutely amazing, incredible talent. And the fact that this is happening is no reflection on the person and these people that are in these roles that might miss out and are looking as well. So that's why I think that hashtag is trending around like hire a Xero in particular, that the caliber of people, if from a employer point of view, the caliber of people out there are amazing. So from an employee point of view or a prospect point of view, just back yourself. You are really, really good. There's a reason that you were doing amazing work in these really, high-flying organizations. And it's just this broader market impact that's created these conditions that's meant that, some of these redundancies have been deemed necessary by the leadership to achieve the outcomes that they want to go after. So don't take it personally at all. It sucks. It's really unfortunate. It's happened to me before as well in the past, and it's just the nature of it that sometimes you just end up in the market sooner than you wanted to be. But back yourself, back your skills, talk to as many people as possible, leverage your network as well, practice interviews, all of that stuff. There's so much amazing support and content out there that you can really improve your ability to communicate your value, that you can find the right match in a pretty decent short order as well. And when you think about the wider ecosystem, if we set aside the complexity at the moment with SVB, the wider ecosystem in tech at the moment, there's still a stack of organisations that aren't those big brands that weren't as exposed as those big brands that are all looking for talent. Like you're talking to them daily.
We had
to
our
find
biggest
these
month
people.
this month all year, right?
Yeah.
And so there's lots happening. You're just gonna be aware that a lot of people aren't used to the level of interviewing or applying for a job. We've been headhunted so much, by recruiters and companies over the last 3 to 4 years that you could just demand any salary and a lot of people were getting it, so that you have to go back to the basics now, like preparing your CV, preparing for interviews, practicing interviews, making sure that you maximize every opportunity that you get, and keep your chin up, because you're going to get rejected for opportunities that you probably thought you would have got normally.
That's it, right? Because there's that sort of supply and demand. The supply is there. That means employers are going to be able to choose a little bit now, and so it is going to mean that there are going to be some challenges, and so. It's just the nature of the market. But I agree with that point around keeping your chin up as well, because it's just going to be a bit competitive for the near term, and hopefully things will improve in the medium term.
Obviously, we've talked a lot about the past and what's happened. Going forward, what can we do to put ourselves in a better position as startups in New Zealand, particularly?
Yeah, well, one of the things that founders, really focused on the customer problem, really focused on making sure we're solving their needs in a way that can be profitable, that they love, that's scalable, that's hard to copy. All of that's really, really important. If you don't have like a financial advisor that's really close to you, or someone on your board that really understands risk and risk management as well, or you don't have necessarily a CFO or that kind of role in your business, generally think about getting some of that advice and getting someone to have a look at look over your operations, have a look at your balance sheet and where things are at and what your risk profile looks like. Because that example of do you want to be paying should I be paying multiple banks for multiple sort of account fees, right? That sort of thing. On a monthly basis, it's not a big number, that kind of the outlay to have a little bit of insurance in a way that you've got your risk spread a little bit. But if you've done that proactively, it means when one of these shocks comes through the system, you might be in a better position. And so, getting a bit of advice from someone outside the business, or hiring that CFO or a finance manager inside of the business that can help you just have a look at what's going on. And virtual CFOs are pretty good in this space as well. And I know a lot of virtual CFOs around New Zealand are doing amazing work with founders and founding teams that can get a lot of that advice without needing to necessarily carry that headcount as well. So
I know Matt Dole from Oxygen is pretty busy at the moment.
I bet.
He probably has about 50% of startups on his books.
Yeah. So the Oxygen are doing a great job, and shout out to them. There's a number of sort of fractional CFOs out there as well that are doing this kind of just one, on their own bat as well.
So a mate of mine, Rob Marshall, has been pitching me the idea for years, right? That there should be a little consultancy, just like a risk and assurance type consultant that comes into startups and helps them think better about risk and assurance in startups from an earlier stage. Is that something that you subscribe to? Is that something you think about? Or
I think it's a really interesting idea. I think it could be a really valuable part of the governance process that traditional boards and traditional organizations, they get an auditor in, like it's part of the nature of those, the way they operate. There's nothing to say that shouldn't scale down to smaller startup organizations as well. There are there's a lot of lower tier, they sort of tier them in the accounting firms. I mean, that's my background as well, but some of the second tier or third tier firms can do audits for relatively cheap compared to some of the fees that you'd pay for some of the larger scale ones, but they might not have the same experience in the startup industry as well. So there might actually be a sliver there of value that could be carved out to be able to provide a bit of comfort to VCs and boards and founders as well, that the material stuff that's important to look after, like how you've invested your rounds of cash and also just controls in general in your business and how that risk is being managed, is appropriate for where you're at. And that's cool. You get the information, you know what you need to do, or you can ignore it and take that risk on yourself and carry on. But it's there could be a market there.
Yeah, I remember talking to him about it over many beers, thinking that for me it's good. Yeah. So you mentioned that you started in risk. Like, can you give us a quick 5 minutes on your background for those listening that go, well, who is this guy? And, where does his reckons come from?
Who's this punter? Yeah. I started my career with Deloitte. Before that, I'd just done a bunch of sort of contract software development, but I really got my teeth into my career at Deloitte, working in all kind of manner of risk and risk management. So traditional auditing, but also internal controls and IT auditing, and a little bit of security, like penetration testing from a digital side as well. So that was sort of the grounding for a good chunk of the start of my career. Spent a bit of time offshore as well with Deloitte too, so had a good range of different industries and clients that we worked with. And then I moved to work with Icebreaker. So it was a Wellington-based company at the time, and I was in the finance team there. I was financial controller there, so got a good understanding of sort of breadth of commercial relationships and banking and diversifying that as well, and growth, because that was absolutely going gangbusters. Then moved on from Icebreaker into Xero, and that was 8 years on the trot with Xero in all kinds of different roles. I started in the finance team and then actually took a bit of a left-hand turn and jumped into strategy, commercialization, product, and ultimately operations as well, is where I last had a role there. And that was... I've always I've subscribed to this mantra that you scale your career in a scaling organization, and that's why startups and scale-ups are so fascinating to me, because you just get to see so much variety, so much diversity in all sorts of different things. And if you're enthusiastic, you've got a skill set that you can bank on, and you get stuck in and want to solve some problems, those are the places to be. That's why I fucking love startups. Like it's all about that. And so that led me to end of last year, and I moved on from Xero, and I've just recently taken up the role as CFO at Storypark, which is early childhood education technology software based here in Wellington, but customers based around the world.
Awesome, mate, awesome. And so people listening now, thinking about startups, thinking about VC, thinking about banks collapsing, are thinking, what am I doing? Should I go into a startup? For someone that's been through it and been through a couple of GFC now, and then now SVP. I don't know what we're going to call this era.
I think it's the copper age. I think it's going to sort of go past golden and be a little bit copper. I think for a little bit, but we'll see what happens out the other side of it. But sorry.
So should someone still go into a startup? Do you think?
Oh, for sure. Like it depends on your risk appetite, right? And if you're interested in learning the most you can possibly learn in a short amount of time, and figure out what you're made of and what your career could possibly be, get a good sort of overview of all kinds of different things that in business that it could be that you'd be interested in, from sales to go-to-market, marketing, operations, product development, engineering. Like there's so much that you can just get a really good sort of over-the-shoulder look at what's going on and get an idea of what might be really interesting for you to really go hard on in your career. But there's no better time than to join a startup. I think this current little blip that we've got with SVB in particular is going to make things a little bit uncomfortable for the next few months, but I do think we'll come out the other side of it and be pretty okay. But the sort of the hiring side of things as well, and some of those reorganizations that are going on, I think that's going to create an opportunity for a lot of startups to actually get hold of some really good talent that they couldn't get hold of before. And that's actually going to create a whole bunch of, right now, much smaller rocket ships that previously were actually quite hard to really fire up, because a lot of the talent was concentrated in some of the bigger brands. Yeah,
I 100% agree with you. If you look at the GFC, the amount of cool startups that came off the back of the GFC, you had people, super talented people joining small startups. You had people, super talented people going and starting their own startups. And then the spread of wealth of talent, is such a phenomenal thing. And so, like 800 people at Xero going out to stimulate the ecosystem with the amount of talent they have excites me. I know it's a horrible situation that people are going through, but it excites me for the future, because if you look at things over a 10-year lens and say, all right, this little blip that we're going through now is a kind of probably needed. The market was pretty crazy, like from a recruiter, some of the salaries that I was telling clients, was insane. I shouldn't say insane. It wasn't, they were just unrealistic, I should say. And so, it's the future for me definitely looks bright, but I think we're definitely in for a couple of horrible, potential months.
It's not going to be a fun couple of months, I think, but it's the future is bright, to use your words, for sure. And the thing that we're also forgetting a little bit as well, remember the pandemic? Remember that thing? Heaps of people lost their jobs at the start of that, right? And heaps of people then went and founded some stuff, and then that actually created the thing that was all of the volume of cash that went into as well. And so with all that extra money that came into the market, that's what created this bit of a sort of quasi bubble that we're talking about. But change/chance, right? It's the opportunity and of a founding of a whole bunch of great things. So I think as long as everyone's staying upbeat and sort of keeping propping each other up as well, and checking in on your friends and making sure that we're all looking at this as a challenge that we can overcome, then I think the industry as a whole, startups as a whole in a sector, is going to do pretty well long run.
Excellent. So for those listening, I think that are aware of some New Zealand startups that don't have access to their money at the moment, look, let's do whatever we can to support them. If we can hold off on sending them invoices, if we can do anything to support, help them, give them an ear, to let them cry on our shoulders, to support them in any way, please do so. Let's not try and create any more panic. This is it's an easy time right now to throw stones. It's an easy time to pick on the industry, but I look at everything that's happening on Twitter at the moment in the US, and there's a lot of people laughing. For me, fundamentally, this is about the smaller startups now that are trying to pay employees, and so we need to think about that.
Totally, This is not the time for any sort of predatory investment behaviour as well. Someone's a bit stranded, cool, I'll give you this, but give me 20% of your business. If that happens, I want us to be able to be taking names of who's doing that in the market. If they've got the money to be able to exploit this as an opportunity, I'd be pretty pissed off if that's what's going to happen in the industry at the moment. I hope and believe that a lot of certainly the local VC community are going to do right and really try and support and create opportunity out of this rather than exploit. Yeah,
I've already seen the start of that with some posts from VCs in New Zealand online about how they're supporting, and I fucking love that, right?
It's brilliant, Which is the point, right? You create an ecosystem, you create a community, you create future opportunities, because this place is too small. New Zealand's too small of a market, and a money-based market as well. It's too small to get a bad reputation for doing something dodgy like that. So I don't think it will happen, and I'll just be really annoyed if it does. But I think our VC community is pretty solid and really believes in founders, believes in the story, believes in where we need to go. And this is just a really unfortunate sort of credit and capital snarl up that's going to unwind. It'll just take a little bit of patience and a little bit of forgiveness around the place, and just let's all look after each other.
Excellent. Danny, hey, thank you so much for coming on a Sunday, mate. I was scouring the internet, reading everything I could get my hands on over the last couple of days, and I kept coming across some comments or some posts that you'd made on the subject, and it was intelligent, it was articulate, but it was also for people like me that are a 5-year-old in terms of finance knowledge. It was really good and easy to read. And so I thank you for coming on. I thank you for helping educate our audience on what this is. And yeah, man, I wish you all the best in this new CFO job at Storypark. I think I think you're a smart and lovely guy, so thank you.
Thank you, Troy. I've really enjoyed it, really enjoyed the conversation. For a 5-year-old understanding of corporate finance, I think you've done a pretty bang-up job, man, so don't sell yourself short.
Thank you so much to Danny for coming in on a Sunday and having that conversation with us. It was a really interesting conversation. It was really good to break it down. For those of us like me that have the 5-year-old knowledge of a finance ledger, it's important for us to understand what's happened, why it's happening, and what potentially could happen in the future. So thank you so much for listening. Thank you so much for watching. Thank you so much for the people that are subscribing. Your numbers are continuing to blow up, and we're really, really loving it. We're loving that this is getting out there right across all the internet now, and I want to thank you so much for everyone that's given us some love and attention so far. And for those that aren't, this is your opportunity to jump on and get the love from me next week. Until then, bye.
This podcast is produced by John Otaka from Empire Films.